How are you doing, Nick?
Hey Igor, how's it going?
Nice bike behind you.
Thank you. It's not mine.
Not yours yet. Okay, guys. I'm trying to just. Okay, let's try to share the screen. Okay, can you see the screen?
Yeah, that's a good choice. Lithia, I was actually looking into it.
Yeah, I guess I read your mind. Okay, just a second. I'll open the chat and I can see everyone who joins us. All right, so we're going to speak about this retail automotive industry and in general Lithia Motors. Okay, so as always, before we start, disclaimer, guys, just put pluses that you understand that it is an educational webcast and it's not an advice, right? Okay, and let's start. So first of all, we'll look at current market situation, what is happening, and then already we're going to discuss the industry itself. So if you have any comments, you can straight away tell something about it. Okay, so your opinion. So let's start from Dow Jones. So Dow Jones, as you can see, that's what was happening since June. So we had like these nice rolls, and the higher point was higher, the lowest point also higher, tiny bit but higher. All right, and like I would put this as a kind of certain level around 35,500, 600. So because look, what was happening, very similar situation what happened last night, last trading session. You can see this is pulled from 3,000, something like 350, and then moved all the way up, and then we saw this red candle. So it's looked like we tested those levels, and then it's looked like we're going to go down, but then all green candles all the way to the new high, 36,558. Okay, and then we already went down. So at the moment, very similar situation. So again, we broke through this kind of level, two levels actually, right? And now we see this very lovely red candle. So it looks like we're going to turn around, especially that indicators are showing that we're in overbought situation. And it seems like we're going to sell, but they're not crossing the lines yet. So, and very possible what we're going to do, something like that. So we'll see it probably within like this trading session or maybe next trading session. Okay, something like that. So this is what happens with Dow Jones, and if we continue to grow, so definitely the next level would be 36,500, so previous high. Okay, if we break down, uptrend and start going down, so very possible we're going to be ending up somewhere close to this bottom of this trend. Okay, so so it's about probably 7% drop if it continues down. Now, similar situation with Standard & Poor. The difference is that we actually have the same level where we bounced already 2 times. We bounced in the beginning of November, in the middle of November, and now the beginning of December, right? So again, we had only couple good sessions, and we actually reached this level. And last trading session, we can see this red candle, which is bigger than previous green. And so very possible what we are going to reverse the direction and end up somewhere close to 4,500, somewhere close to those levels, very easily. And it's still going to be uptrend. But if you're planning to enter the position, pay attention to the indexes because they can go down as well. Now, this is Standard & Poor and Nasdaq, similar to Dow Jones. We can see it's like similar high, which was about 16,500 when we went a bit higher. But this level already 3 times. Once, okay, here, second time, and now the third time, and we bounced it back. So very possible that we're going to drop down somewhere here. Okay, pay attention to this level or even lower to 1500. Very, very possible. Now, Nasdaq consists of all these 80 companies, and it is the biggest like market at the moment. So if you especially trying to buy companies included in that index, so make sure that you pay attention to that, right? So in VIX, as you can see, we at the moment, even though the index is at the high, but VIX is not as low as it was before. So it means that there is some fear on the market still there. And at lowest point was $15. At the moment, it's $20. Right. So as you can see, with like during the last year, we slowly kind of lowered the lowest level. So it was 26, after the 24, 22, 19, 18, and the lowest point for the last 6 months, it was $15. Okay, now we bounced nearly to $36, pull back very quickly, but still not there. Okay, so and you can see indicators are all in over bought situation or sold situation. So it is quite possible that it's going to turn around. It means that market is going to go down as well, right? So the one thing I wanted to show you, despite the markets are so high in price, but when you look at valuation at earnings of those indexes, you can see that actually the earnings are improved during last year more than the price increase. And that's why the PE ratio dropped down. So last year, PE ratio for Dow Jones was 29, same time last year. At the moment, it's 22. So it means that despite the price growth, the earnings growth happened much faster. Okay, so we kind of picking up with earnings. Similar story with Nasdaq, but not as much, only around 10%. Okay, earnings went up, but you know that majority of those high tech stock, they're quite high. And Standard & Poor also PE ratio improved quite a lot. I mean, it was 41 last year, now it's 28. So it means that the earnings of those companies, they improved quite a lot. And the main reason is because government printed so much money and people had extra cash. So of course, what to do with it? Yeah, they went and started buying everything. And as a result, whatever they buy, it's a profit of companies, right? So the companies improve their revenue, improve their profitability, right? So make sure that you're paying attention to that, because a lot of people are saying, oh, markets are so high, but yes, they look high at prices, but from valuation point of view, they're in better situation than it was last year. Okay. All right, this is indexes. So let's go for retail automotive industry. This is quite huge industry, and even though it's one industry, but the businesses included in this industry, they could have very different business model. And some of them, they sell only new cars. So for example, if it is dealership for, let's say, for one particular brand, and they can sell only one brand, or they can sell new cars and second-hand vehicles. Majority of them, they sell like that. And some garages, they sell everything. They sell different brands, they sell new, they sell old cars, second-hand cars. So quite variety. Okay. Also, some of them, they offer the finances. Usually, majority of these kind of automotive branches, they have some kind of financing availability there. Okay, and also provide insurance as well. So some of them do that. Some of them just outsource it to external providers. And also aftermarket parts, equipment, tools, and accessories. And some companies, they work only in this area, so they don't sell any new cars. They just provide parts or services. Okay, something like that, and service repair. So I presume you understand, guys, that if the economy is getting worse, so the first effect which we have, it's a new car sale. And if you go back to 2008, that's exactly what happened. Majority of companies which was selling new cars, they suffered quite a lot. And we're going to look at Lithia Motors today as well, because it did suffer at that time. Now, but this pandemic was different. if we compare it to the previous, because it is kind of the crisis in general, but the governments, they dealt with it in a very different manner, right? And as a result, during the COVID-19 pandemic, those companies, they actually performed better. And the main reason, first of all, that people couldn't travel, so they chose to travel within the country. So they start using their cars. That's one thing. Now, secondly, a lot of people, at least whatever industry analysis says, that people who never had cars, they start buying cars because they were afraid to travel in public transport using like trains, buses, because they don't want to get exposed to COVID-19. So they would buy a new car. So they become users. And it's all boosted the sales level of those companies. In addition to that, extra cash. So a lot of people got cash, even if they are not working, they still get cash. And so they have plenty of it. So it's not like 2008 when people had problems with jobs and payments, etc. So people can go and buy the car and change the car, right? Another thing is still low interest rate. So people can borrow money if they want, okay, quite low. And of course, they can use this cash to buy something. And another thing which has also affected the profitability of the companies in this industry is the price increase, because there was a shortage of those cars and spare parts, not spare parts, but the new cars. And as a result, dealerships, they increased the prices for a lot of vehicles. And the expense is exactly the same, but the selling price is higher. So the operation margin increased, and the companies in this sector, they made extra money just for selling the same amount of cars, okay, which is kind of pretty good for the businesses, all right? And it doesn't really matter if they sell new cars or second-hand car. Now, although some dealerships, they suffered quite a lot, especially the smaller ones, because there was a delivery problem with if the manufacturer facility somewhere in the US and they manufacture some parts overseas. Because of COVID, there was a problem with delivery, and some companies, they suffered because of that, and they couldn't deliver the vehicles to their customers. And generally, the delivery time increased quite a lot. So it used to be 24 days, now it's several months, okay, for new cars. That's why there is a quite huge volume for selling second-hand cars. Now, recently we looked at a company called Automotive. It was Chinese companies, and it's kind of the platform for selling vehicles. So they don't actually have retail shops themselves. And interesting enough that some of the companies, they start introducing that as well. So and the Lithia Motors, they have facilitated a similar type of service, so people can buy and sell cars and get some additional services from Lithia Motors. All right, so this is like that. And another thing which is direct relation with economic situation, I already told it, and high level of competition. Another thing is also high level of debt. Usually those companies, they have very, very high level of debt, very often half of capitalization. Okay, so this is the level. Now, if you go and read this like in general industry analysis report, so you will probably find exactly the same what I told you. And the only thing probably I will add that a lot of companies, big companies during this time, they chose to aggressively expand, because smaller businesses, they suffered still because of lack of supply. So what they would do, they will buy those dealerships, okay? And Lithia Motors, it's one of them. They had placed 2 years ago, they placed a plan to expand and increase their sales level to $50 billion. At that time, they were selling about $13 billion like annually. Their plan was $50 billion, and increase their revenue to net profit per share to $50 a share. Okay, so they're halfway already there, even more than halfway. And so they expanding by aggressively buying new locations. Okay, this is the thing. As you can see that Lithia Motors is not the biggest company in this industry, but I chose it, and I'll explain you why I chose it, specifically that company. So what I've done the screening, and I didn't do it in a value line this time. I've done it in FinViz, and I just put parameters. First of all, I chose this specific industry once because value line has 14th parameter, like it's pretty good one industry. So, and it has timeliness one as well for a lot of companies. So, and then I put P ratio under 15 and earnings per share growth in past and in the future of 10% or more, right? And I think it was more around 20 companies in total in FinViz in that sector, and only 2 left. Okay, actually, when I put first initially just P ratio, a lot of them got into this P ratio factor, but a lot of them weren't profitable. Actually, when I saw in value line first initially, the companies, when I screened it, and I found that a lot of companies in this sector, they have P ratio below 10, I thought, oh, maybe it's better to buy just the ETF, right? Industry ETF, and then to make money on it. But then when I looked in general industry, I realized that in at least half of the companies, they are not profitable at all, so they're losing money. And a lot of them not growing companies at all. So that's why in general, because of high level of debt, usually the valuation for this, the companies in this industry is quite low compared to the general index. Okay, so that's why you have to pay attention. So this company, which came up to the screener, P ratio is 6.6, so it was growing, right? But based on whatever FinViz is telling us, forward P ratio is 8. So it means that during the next year, maybe during the next 5 years, they're planning to grow because they go into the screener, but next year they are planning to have less earnings, right? So that's why forward P ratio higher than current P ratio, right? For Lithia Motors, it's different. So current P ratio is 8.4 and a forward P ratio 7.6. So it means that they are planning to grow next year as well in their earnings, okay, which is good. Now, as you can see, they're still sliding down. And actually, if you open a lot of like different companies in that industry, you will see that all of them, they have, not all of them, but a lot of them, they have a downtrend. So they're sliding down. And when you see this general pattern among the industry, it means that it's not the internal problem for specific company. It's just general problem, which is like problem related to the whole industry, right? And this is the very good opportunity for investors because if the problem affects generally industry, so people short, like start selling the companies included in that industry, but some of the companies, they're not financially, fundamentally not suffering, right? So, and it gives us opportunity to buy very good companies at discount. So, and I presume, like personally, I believe that Lithia Motors is one of those nice businesses. Okay, so that's how it looks like, Lithia Motors. So it's, as you can see, it says that 90% of population within 225 miles. It's pretty big distance, but still they're everywhere, all right? And especially taking into consideration that they don't sell only through dealerships, they sell online quite a lot of vehicles as well. And this is the good opportunity. And also they have this service. When they provide the service, they can deliver a vehicle directly to your door. And also they can pick the vehicle from you. So if you, for example, decided to sell your vehicle and you go online and you start selling through Lithia Motors, so you sell it, they come, they pick up and then bring it to the customer, to the person who bought it. And also the good thing about them that they provide they can provide the financial services. So for example, if you in Australia go to car sale yourself and start selling something, so the person has to go somewhere and find the finances from the bank in order to buy it from you, okay? And usually banks, they don't like when it goes like private sale. So Lithia Motors assisted in this particular transaction. So it's much easier to sell when people buy by getting a loan from the bank. Okay, hi Max, how are you doing? Okay, so this is where the allocated, the business mix is, it's a bit changing. So look, if we compare financial year like 2015, 2019 and the last quarter, so you can see that from revenue perspective, they had 60% new vehicles, 30% second-hand vehicles, and part and services 10%. At the moment, new vehicles last quarter was 50%, right? 40% in used vehicles and 9% services. So the second-hand vehicles level increased quite significantly, right? And you can see that the profitability about the same, even bigger. But if you compare that new vehicles, even though they have less sales, but they still have very good profitability, 42%, which is more than it was used to be. So it tells us that marginality is there. Okay, so something like that. The services drop down, and that's what kind of cars they sell. So they have imported cars, so Toyota, Honda, Subaru, Hyundai, Nissan, and other, right? So domestic cars, so Chrysler, GM, Ford, and also luxury, but also imported, right? BMW, Mercedes, Lexus, etc. So, but not as much, right? So majority of this, look at this Toyota on top of the list. And so as you can see, the company is not selling only what type of vehicle, they sell a huge range of vehicles. And when you go to their branches, right? So you will find a quite huge choice to choose from. And this one, this last few slides I took from their last financial report. So if you want, I can actually put it in our club membership platform. So, or you can download it from their website yourself. But what I did is just to show you where the majority of income comes from. So you can see that new vehicles, 2,898 million, used vehicles, 2,079,000,000, right? And this is Q3, and you can see how it's Q2, Q1, right? And wholesale used vehicles, so they sell in wholesale also, finance and insurance, and service, body and parts. So, and also they provided like fleet and hours. I'm not sure exactly what they mean by that, but I know that some of somebody's speaking. So some companies like that, what they do, they lease their cars to companies like Uber or Lyft. Okay, maybe it's something like that as well. They provide it like that. So, but the important part here to understand that this company can be subject to economical effect. So if there is a crisis, so guys, I don't know if you hear this beeping. I'm not sure if it is my place. Just a second. I'm going to check it. Wait a second. I just switch off the video. Sorry, it was an alarm. Right. So in any way, it's very important to understand. So if something happens with the economy and people stop getting all this extra help from government and cash disappears, so the company will suffer quite a lot because majority of their sales is new vehicles. Okay, and we're going to look at this during the value line analysis. Right. So let's have a look. That's what I'm saying about the company. So that's what their plan, and they acquire strong brands and grow profit. So this is how they're planning to increase. When they buy something, they're going to improve their businesses. So they're not only expanding by buying new locations, but also improving the existing locations which they have, and when they buy it, they improve them as well. So because they're quite good with their business processes, So that's why it's very difficult to compete with Lithia Motors on that part. And also what they do, they sell a lot online. So they improve the online sales, and by doing that, they reduce the cost, because majority of vehicles, they are sold without sales commissions, which kind of usually sales assistants, they have quite a huge sales commission. When you sell online, there is no sales commission to the people. Okay, so something like that. All right, so let's have a look at value line. Value line report came up, I think, in the end of October. 22nd of October, so it's already nearly 2 months old. But in anyway, so the price was $320 at that time. Now it's $280. And let's have a look what was happening. All right, so now, first of all, I'd like to show you 2008 to 2009 and what was happening there. So you can see that they had about $162 in sales per share at that time, right? And you see in 2008 it dropped to 104 and then 67. So from the top number 163, it's like 2.5 times dropped in sales. And as you can see, their profit, which was $2.60, it's actually was sliding down even before the economical crisis, right? GC, and but then it was negative to $8, which is huge. Right, so it's once again tells us that this economy, this type of company and this type of industry, they're subject to economical changes if something happens, because people stop buying new vehicles, right? But after that, look, the sales levels start growing up, and every year it improves. And so for the last 13 years, right? So the company every year improving the sales. And as you can see, like 3 years ago, it was 400, 500, 540, and 700. Actually, we can see here the drop in sales per share, right? But if you go to sales in general, where is the revenue? We have here now net profit. Revenue, right? So we see still growth. The company was growing, but because they issued new shares, we can see that the company for the last few years, since 2019, they increasing the amount of shares because they have a plan, right? So, and as you can see here in value line, they specifically notified that to recall the company intends to achieve $50 billion in revenues and $50 in earnings per share by 2025. Okay, 1 year after launching the plan, Lithia has reached approximately 40% of its target network expansion goal. So, all right, so it means that they're not only talking about it, actually doing this stuff. All right, so which is pretty good. And we can see that they pay dividends, but dividends quite low. Okay, so it's a very tiny dividend compared to general. Now let's have a look at debt level. Debt level of 4.2 billion and capitalization at the price of 320, which is now about 15% less, 9.7 billion. So it's at the moment $8.4 billion, right? And it means that practically half of it in debt. So which is pretty huge debt to capitalization, but I already mentioned it's a normal situation for this industry. Now, for us, it's very important to understand if the company can cover debt. So let's have a look. So here, net profit of 2021 is about 955 million. Last year it was 470 million, but anyway, so now it's 950. Right, so it means that around 4.5 years, 5 years, if they decide to pay off the debt, so they can do it. Right, so this is possibility. Actually, let's have a look at their long-term debt. So we can see the increase in long-term debt. So it went from 1 billion in 2017 to 2.5 billion to current levels. Now, in the major reason is to expand. So they're not only issuing new shares, they're also issuing new debt. Okay, so to buy new locations. Now, but return on share equity is pretty good, so it's 21%, and return on total capital is 14%. So it means if they borrow by like using 5%, so they have higher return, so which is pretty good, right? So you can borrow money if you make more money. Now let's have a look at target price, which value line gives us. Within the next 18 months, value line believes that it might go somewhere in the range between 230 to 580, which is like everywhere, right? The middle part is 410, so it's much higher than the current price, $280. Now, if we go for 5-year projections, a value line actually is a conservative, so they're not telling that they're going to make $50. So they kind of a bit load their plan for Lithia Motors, and but still they gives us the target range between 380 and 580, which is extra $100, 30% on the top of, like at the lowest rate, right? And if 580, it's more than double, right? So it's from the current price to $180. So more than 100% within the next like 3 to 5 years. Now let's have a look at the P ratio, which is so we looked companies growing. By the way, let's have a look at growth rate, maybe before P ratio, and we can see that during the last 10 years, the company was growing in revenue 20%. Now, if we look at the earnings information only provided for 5 years, so we can see 21% on an annual basis, which is absolutely fantastic. So it's fast growing company. And we can also see that revenue planning to grow 13% and 21% in earnings. So as you notice, so revenue is growing slower than the earnings, which is very good. It means that they are not only increasing their profit by selling much more products, but they're actually optimizing their business processes. So they have less expenses. That's why when they increase the sale by 1 point, they increase their profit by 1.1 times. So which is pretty good. And they're planning to do exactly the same in the future. Interesting enough that the earnings predictability rate is 65. So it means that they're not exactly right all the time about their earnings, but I'm going to show you. Usually, if they're wrong in a good way. So they always outperform. At least what I saw for the last couple of years, right? So they outperform. Now, also, I wanted to mention about the current balance sheet, right? So assets and liabilities. So we can see that we have right now $3.8 billion in current assets and $2.5 billion in current liabilities. So it means they have $1.3 billion in surplus. So which is working capital, which is pretty great, right? Compare, especially taking into account the company is only $8 billion by capitalization, and they have debt for $1 billion. So they can pay 30% of that debt straight away from the cash which they have. So I presume they won't do it because they need this cash, but at least if they need, they definitely pretty good in that. So let's have a look at the P ratio. Now, P ratio, as I said, it's not as huge as you would expect for such a growing company, right? Because if the company is growing by 20%, at least you expect P ratio is more than 20. Right? But at this particular moment, P ratio is much smaller, right? So that's why PEG for this company, price earning to growth ratio, is kind of below 1, right? Which is you won't need that often on that particular case. Now let's have a look. Still, P ratio varies, and we can see. Like I'm not going to go too far, but if we go to 2015, its maximum was 15. Right, 14, and for the last several years, it was somewhere 12 at the max, right, and 8.7 at the lowest. Okay, actually, if we calculate the ratio on the minimum price, right, so $55 was last year when during the pandemic crash. Can you imagine the company was making $90 at that time? And $55 in crash. So this is where the people sold off the company because they expected that it will go into negative earnings. But because this pandemic and the reaction of government was different, the company was actually making more money. And as a result, can you imagine if you would buy here, it's P ratio like 2.5, right? At that time, the whole company. So if at the moment it's 200, let's say 320, and for the total capitalization is $10 billion, right? So, and that was $55, so which is what, 6 times lower, right? So about $1.5 billion the whole company worth. So if we would buy that company for $1.5 billion, so at the moment we're making only pure profit $955 million. So which is 2 years and we paid it off. So can you imagine, guys, if we could borrow that amount of money, bought that company, right, and would be very happy in a couple of years. Now, so this is PE ratio. At the moment, PE ratio 8.4. So it is much lower than average PE. But because the company is really volatile, you know, look, beta is 1.2. So during 1 year, can you imagine the changes here? So practically huge, not double, but in some cases nearly double, right? So here nearly tripled. Here it's like 6 times, right? So the company is really volatile. So we can expect that this company can go down very low and then it can go up very quickly and very high as well. So when everything is rosy, people are going to pay a lot for that. When something is wrong, right? So they sell it off. So this is about the company. As you can see, that's the earnings growth. So $1.9 was in 2009. 20, then $3, $6, $7, then $5, $10 last. Actually, the last quarter, I think they about $10 as well in Guru Focus. I looked, so they bet the expectation. So they made more money than expected. So as you can see, they nearly already made this $33 in earnings. So if you compare the current price to 180, to trailing earnings would be about 8. All right. So this is fundamental. So what do you think, guys? I probably already showed you the evaluation, but still, yourself, do you think it's a quality company? Do you think it's undervalued company from whatever you've seen it right now? Is it 4x4 or less? Definitely it is, yeah. So I've done this 4x4 analysis and it came up with 44 points. So industry ranking is 1, so great. Timeliness is good, it's 1 as well. Then safety 5. It's lost 3 points because of that. Okay, that we lost 4 points here. Beta, it's actually lost 1 point on beta, but personally I believe that volatility is a beach when it's high, right? I mean, when the price is high, so it means it can go faster than the market down. But then when it is already low, it means that it can go up higher than the market, so which is pretty good. Debt capital ratio was 33. It's actually more than that, than 33, because at that stage, when they did this report, it was $320 for the share. At the moment it's 280. So if you multiply it, it's about $40 less. So it's around 15%, a bit lower. So it's have to deduct 15% from this valuation. Okay, so it's about $1.4 billion you have to deduct, right? So it would be $8.3 billion. So it means nearly half of it in that, 50%. Okay, so 4 by quality and 4 by price. Now, the thing is, when I was doing this analysis, I was really tempted to adjust some figures, but then decided to leave it as it is. And I'll explain you why. Because this price of $55, which was happened last time, it was unprecedented price. Like it was a panic on the market, right? Usually in normal circumstances, it wouldn't happen. Can you imagine that the profitability on that particular moment in company was much higher than during last 5 years? But look at this. The price is 68, 80, 67, 74, right? So 55 is definitely out of range. P ratio was 2.5 at that time, which is like extremely low, right? So, and that's why it's affected our calculation. And our average low P was happened to be 6. Okay, so and if you use this table specifically as it's supposed to be used, right? So the calculation is a bit off because what we do here, we multiply the highest P ratio, which is 14, but the projected earnings. right? So $44. Value line made not $50. Even the company itself projecting $50 in next by 2025, right? Value line is a bit conservative and telling us it's $14. So if 14 multiplied by 44, the price is going to be around $630, which is still much higher, more than 100% from the current price, right? But if we go for P6 and we take the last year earnings, okay, which is just below $20, so it means that P ratio or the price has to be around $116. Now, why I wanted to adjust it? Because at the moment the earnings already $35, so it's not actual numbers. Because if we take trailing 12 months earnings, it's already $35. So at least we have to multiply 6 by 35, which is around 200, right? So already, so it's much higher than that. But then if we kind of take into consideration that this P ratio was affected by that huge drop, usually it would be somewhere around probably 8 or 9-ish, something like that. So definitely the lowest price would be somewhere where we're at the moment, all right, at this particular moment. So that's why still, even when you place these numbers, P ratio 55, but based on that, it can drop to $100, which is huge, right? So it's 3 times more to drop, which personally, I don't believe that it can happen, because at that time, P ratio will be 3. Why would the company which has such a fantastic growth be sold with P3, right? So kind of normal. And also take into consideration that tangible book value is 105. So it means that if the price drops to 116, it's like selling at the level of assets, so which is I don't think it's going to happen. Now, earnings, it's 2nd of February going to be, so we have few months to play around if you want to play around with this company and not to keep it over earnings. All right, guys, this is the price level. Now, also I wanted to show you STMI. You can see that the company sometimes missing the earnings, so but it's slightly higher here. So this is in the range, this is in the range, this is higher than the range, this is higher than the range. Here in the range, here high in the range, here much higher in the range, plus quarter. So as you can see, the company, and that's what value line was telling, that they're projecting. You see, it's more than $10, nearly $11 here in making profit. So they kind of grew quite a lot. And another thing which is also good from the understanding this company, look at the level of institutional ownership here, 95%. Right. So only 5% is owned by private investors, right? Majority of it owned by institutional investors. So, and interesting enough that out of this, like there is a short float as well. So 4% in short, and short ratio is 3. Even though it's not that big of a number, right, for the short squeeze, but taking into consideration that if those institutions are not willing and not going to sell the company at those prices, so if the price start jumping up, so it's actually they have to buy all the shorters, everything what is on the market, right? So because if it is 5% free trading shares, the rest of it's already owned by institutions which are not going to sell it at the current valuation. So it could be a short squeeze and the price can grow much quicker than in average. All right, so this is kind of one of the things which we have to consider. All right, guys, is all clear about fundamentals? Do you have anything to add on it? I'm just curious, Mick, why did you want to look at this company yourself? You said that you were planning to look at this company.
Same idea. I was scanning, and it appeared in the scan. All right. But and it's actually undervalued according to my research. But technically, I still have to wait a little bit.
Yeah, you're right. So okay, let's have a look at technical stuff. All right, so this is how it looks like since the beginning. So it was $10. Maybe it's already adjusted. Maybe the price was higher, but maybe it's already, sometimes they change the price. So it was $10 when it was issued, and you can see it went to $36 in 2006, and then it slid down to $185 in 2009. So 18 times difference between this point and this point. So it's quite huge difference. And can you imagine how felt those investors bought it here, right? And kind of had this felt here. So, but then within 2009, like within 4 years, it went to the same level. And after that, it started growing up. So between 2015 and 19, this was kind of sideways, but you can see sideways still, it's 120 plus and $80. So it's like 50% increase every year, right? 50% here, 50% here, more than 50% here, and a drop to the same level of $80. It was just before pandemic, right? And that's where they had this expansion plan, and they announced they increased it, and look how nicely they moved up to $40. But at that time, if you take 2019, at that stage, the earnings were, I think, around $20. So it means that P ratio was around 20 as well. Okay, so pretty high. So it was very, very high for this particular company. So at that time they paid, and it's normal, right? So even if you look at technical, like Fibonacci, whatever, the retracement is normal thing to do, right? So they have to retrace lower. So, and it's still downtrend. So let's have a look at the weekly. So that's what we have weekly. So $63, even lower, it was 55, I think, during the pandemic crash. Okay, from 160. So 2.5 times it dropped very, very quickly. That's how people, if you market in general dropped 37% at that time, the general. So this company dropped 2.5 times. So 80%. So that's why if something happened in the future and you have those shares, so sell them as quick as you can, right? Because otherwise, and then buy at the low, because it can drop and drop and drop and drop. And if you trade it, definitely probably use it stop loss. Well, because I know that some people with fast growing companies, undervalued companies, they don't use stop loss, but the company, just because of panic, can drop quite a lot, even though it's fundamentally sound now. All right. So you can see this is the kind of two rolls. If we go lower, so that's what we see. And you can see on each actually earnings here went up, went up, went up, went up, jump, and then slid down. So every earnings is actually dropping, dropping, and dropping. Now at the moment, if we look at this trend, we're at the bottom of this trend, and it's like I want to believe that it's in the end of it, right? But we know that sometimes companies, they do 3 rolls, so it might be another roll. So, but before it goes, it might go to 350 and then drop to somewhere around 250. So it is possible to happen, the situation. But the thing is that here we already kind of, this level 280, we bounced a couple times here, went up, and at the moment on a good volume, it's good volume, right? So we're moving up. So it seems like we're going to test this level, definitely. But if you're trading, if you're not long-term holder for this company, so there is opportunity probably for trading here as well. So, right, but definitely it's downtrend, and it's kind of a bit scary, right? So to enter a position, even though the company looks fantastic fundamentally. From the other point, if it start moving up, it start moving up really, really quickly, right? So you wouldn't miss this opportunity. Okay, and the indicators stay in overbought situation here, so it's quite possible that people start selling it, all right? So, and that's why I would definitely keep an eye on that myself, already like Mixer. Okay, so this is my ideas about trading. So if I am long-term buyer holder, so I definitely monitor until the trend turns back up and buy at confirmation. It could be 217. So if it drops, let's say to those levels, right? So at least some kind of level, and it's nearly 50% from the top, so quite possible to be there. If we turn around here, so buy it and then to hold like at least to 460, right, or above even, it can go to $600, right? So a possible waiting period 2 to 3 years. And so it could be 65, 100% profit more plus dividends. Dividends are small, but still you can make some money on it. And if you do trade and more active on the market, so you can do really easy here, 7% on a roll, around $20. So let's have a look at them. Oops, sorry, I'm clicking different way. So if we look here, so the price is around 280 and here 304 somewhere here. So this is roll. So it means about $24. So roughly, right, 7%, 6-7%. So here it's even more, 320, 350. So here it's $30. So again, about 8%. So compare from that price. So that's what you can make money. Even if it is downtrend, you still can use those rolls to make some money, but use a stop loss. So if you see something like that, you can exit with some kind of loss. At least that's what I would do in this particular case. Now let's have a look at if it is possible to trade options here. Now, as you can see, first of all, monthly strikes. So there are no weekly options. Secondly, $10 difference between strike prices, so quite huge. If you look at bid and ask, nearly $1, here nearly $2, right? So here nearly $3. So not good at all, right? From the if you decide to sell and buy, or maybe it's because I took when the market was closed, but still, right? So quite huge difference. And let's have a look at price premium. So if you don't go a bit out the money for put $280, so you get, let's say, $470. So it's pretty good income. Like, I mean, 1.8% for 3 days. If you go for 1 month, a bit more than 1 month, 10 days more, like 38 days over the Christmas, $13. Maybe if you bargain, you get something in between, maybe $15. So it's nearly 5%, a bit more even you can get for 1 month. So not bad from the option perspective, but if you consider the income which you can generate from buying and selling, it's not that good. I mean, because if I look here and I can buy 208 and sell $24 higher within 1, 2, 3, 4, 5 days, so why would I keep it for a month? An option where I can make money by selling like shares. And I wouldn't probably do sell put and buy it back because the spread is quite huge between bid and ask. So they will take a chunk of your profit on that particular case. So this is like that. So if we go for longer periods, for example, to buy call, for example, to protect ourselves, because we don't know, maybe it go to 217. Actually, it's not that long. The longest call available option available, it's only 185 days until June next year. So, and it's definitely with all this pandemic stuff, it can, like, if some kind of happens bad stuff, right? So it can go much longer than a year. So, and I want to be able to hold the company for longer period, but still. So if you don't want to risk, you can buy call, but look at the price of this call. So you have to pay nearly $40 for $28 strike. So it means that it's what, nearly 14%, right? 13%, something like that, in the price for less than a year, 9 months. So definitely expensive stuff. Okay, Mick is writing, I guess for long-term holding, maybe it's safer to buy a small amount at certain intervals, at least until trend changes. The premium is good indeed, but 280 is risky. Yes, correct. This is my opinion. So if you have, guys, any questions, any comments, please mention. Jeremy, Max, what do you think about it? Okay. All right. So if you want to talk about any other companies, let me know so I can open the chart. We can guru focus and we can go through them. Hi, Dory. Yes, absolutely. I absolutely agree with you, Max and Nick as well. Hi, Dory. How are you doing? You just on time? We just completed the masterclass. So if you guys want to go through other companies, let me know. I can put it in the chat and I can open the Guru Focus and go through financial data if you want. Okay, while you're thinking, I just probably a couple things. Okay, we had a picnic. It was very nice to see everyone, Jeremy, Max. Dory couldn't come, Mick as well, yeah. So this is a picture from there. Is it Mick, you, right? So, okay, so yeah. And this is the picture. It was fun, yeah, it was good. Nice food, I really enjoyed it. We had a party after that as well. It was my father-in-law's birthday as well. We went to a restaurant. So again, just want to repeat so that last month there were 2 new projects opened for development. So if you guys want to know more about it, you can download them here. So you can go to sydneyinvestmentclub.com. So there is an application form, but after that it would be sent you directly to the link where those projects, information about those projects is available. Okay, but you can contact me and I can provide you information about it. The profitability of those projects 20% plus annually, so something like that. Okay, some of them more. Also, there are some projects long-term hold, and it can give you about 10 to 15% rental return. So if you do it, and also what they introduce now in the development is that you actually can have a secure 12.5% return. So if you go for variable, so roughly they do 20% plus, so it can vary. But if you want to secure your interest income, so it would be 12.5%. So, and you know that that's exactly annually you're going to get in the duration of your project. All right, so this is it, guys. If you have any questions, as I said, if you want to go through some companies and have a look at them, you want me to open their fundamentals, technicals, we can discuss them. So type them in chat and we'll go. Right. Otherwise, thank you very much and Merry Christmas. All right. Okay, so guys, enjoy your Christmas time, and I will see you during next year. All right. All the best.